Today, on The Bottom Line, could Bitcoin be a true substitute for gold? And Scott Nations teaches us lessons from historical market crashes. Plus, Wells Fargo's John Manley explains why you shouldn't try to call the market peak. Hello, welcome to The Bottom Line. I'm Sara Silverstein, in for Henry Blodgett. We are at the NASDAQ market site in the middle of Times Square. The show is presented by Fidelity Investments. This week in the markets, there was a rough week for a few companies that IPO'd this week. Blue Apron, which IPO'd at the end of June at $10 a share, has been slowly declining since then. And this week it got its first Wall Street analyst recommendation. It IPO'd at $10, and the analyst recommendation from Northcoast Research was $2 a share, saying sales growth at Blue Apron is dependent on discounts and isn't sustainable. That price record is 80% below its IPO price. But Snap also had a bad week, which was one of the biggest IPOs this year. Snap IPO'd at $17 a share in March, and on the first day of trading was up 44%, but has since come down slowly, but didn't break down below the IPO price until Monday of this week, where it closed a cent below $17. But on Tuesday, Brian Nowak of Morgan Stanley, which is one of the underwriters of the IPO, came out with a note where he'd cut his rating for the stock from overweight to equal weight and cut his price target from $28 to $16 a share. This week's bottom line is gold versus Bitcoin. Fundstrat's Tom Lee, who talked to Henry Blodgett 2 weeks ago and said that everybody has room for alternative currencies in their portfolio, came out with a note over the past week saying that Bitcoin could be a true substitute for gold. In his note, he builds a foundation for a valuation of Bitcoin that he estimates could go to $20,000 a unit by 2022, which would increase the price of Bitcoin eightfold in the next 5 years. His valuation is based on the assumption that Bitcoin, which currently is about $53 billion in total, to gold's $7.5 trillion. So Bitcoin makes up about 0.7% of all of the value if you look at what he would call alternative currencies, including gold. He says that that could go up to 5%. And his entire valuation really hinges on that change. So if we unpack that a little bit and we look at the similarities between gold and Bitcoin, the similarity in supply is certainly there. Most of the gold that's ever been mined is still in existence today, and the supply of gold has been growing at about 1.5% a year. Bitcoin has a ceiling built in for the number of Bitcoins, and as you mine Bitcoins, they become harder and harder to mine. So the supply of Bitcoins dropped from 9% last year to 4% this year, and Lee estimates that the growth rate of the supply of Bitcoin will fall below where gold's 1.5% by 2020. So on the supply side, Bitcoin and gold do look a lot alike. On the demand side is really the question. And Bitcoin does provide a store of value like gold, and unlike other currencies, it's not subject to central banks increasing the supply and changing the value that way. But the rest of the demand does bring up an issue. Tom Lee points to central banks, which own 18% of gold. However, whether or not they'll actually start buying Bitcoin is a real question. And Henry Blodgett has pointed out on this show before that Bitcoin doesn't really have intrinsic value, which we all know that gold does. You can take it, you can have it delivered and do stuff with it. So if you think that Bitcoin can and will cannibalize some of the money that's going into gold, then it makes sense to say that there could be huge gains in store. But that's a big if, and that's the bottom line. Our first guest today is Scott Nations, Chief Investment Officer of Nations Share and the author of A History of the United States in 5 Crashes. Very excited to be here with you. I am reading this book, reading it on Audible, and the narration is pretty good, I'll say.
That's good to hear.
And so I'm most of the way through it right now. Can you tell me what the commonalities in studying the biggest 5 crashes in history, what you noticed or what you learned?
Well, the reason I really wrote the book, there are several. One is the drama in each one is really incredible. It's a little bit like the Titanic. We know how the story ends, but we enjoy reading the story, hearing about the story. But the reason I wrote the book was because the similarities between the 5 modern stock market crashes, starting with the panic of 1907 and ending with the flash crash on May 6, 2010, even though there's more than 100 years separating them, the similarities are really striking. And the goal of the book was to point out each of the similarities and show how they happen in each of the 5 modern stock market crashes, potentially helping people identifying when they show up again. Now, this is not a the sky is falling book. I think everyone who has even a passing familiarity with the stock market will enjoy it. But the similarities really are striking. We know that the stock market really gets ahead of itself before every crash. There's an old Merle Haggard song, I only fall when I'm on the mountain. I mean, we know that the stock market, it's kind of tough for the stock market to crash when it's already in a trough. But there are several similarities. One is that there's always some sort of financial contraption that gets out of control. We think it solves some sort of problem, but there's always a financial contraption. And there are also always some sort of external catalysts that really touch off the crash. I like to say that there's an external catalyst, often has nothing to do with finance, that pushes a market that's on the ragged edge of equilibrium into chaos.
And after studying all of this, is there anything that you're seeing today that people should be concerned about that we're not, that we might be missing?
Well, it's easy to see what's going on at any time and think, oh, maybe this lines up for a crash. Maybe this is the contraption. Maybe that's the catalyst. But I think the interesting thing is to look at the contraptions. And so, for example, on May 6, 2010, the flash crash, the most recent modern stock market crash, the contraption, if you will, was algorithmic trading, which had absolutely no human interaction, no human filter, or no brake that a human could apply. In 1987, it was an insurance program. We called it portfolio insurance, which was supposed to solve a lot of problems. In 2008, it was the alphabet soup of mortgage-backed securities. And so I think one thing that people should look at now, and they should do this as long as they're investors, is what contraptions are poorly understood, not tested under stress, and might unravel when the market does enter a period that is stressed. And you can look at that now and potentially see that. That doesn't mean that just because there are new contraptions out there, new financial products out there, it doesn't mean that the market's going to crash, but that's something that people can pay attention to.
And you are a financial engineering expert. You run a financial engineering firm, and you talk a lot about the dangers of financial engineering, and as you mentioned just now. So looking at the products that we have right now, are there any that raise flags for you?
Well, I'm a giant fan of ETFs, but you can imagine a situation in which some of the illiquid ETFs would have a tough time providing liquidity for people who wanted to get out when the stock market was really under stress. And we know that liquidity disappears when people desire it most. It's just a function of the way the stock market works. It's one of the reasons that stocks generate over time a better return than some other asset classes. It's because you can't always get out just because you want to. I think there's another potential contraption, and that would be some of those risk parity investing. Parity meaning that there's either some sort of leverage that's used, or people say, I'm going to get out as the market starts to cascade lower. Well, we know that that doesn't work. We've tried that in the past. The risk parity investing, I think, really flies in the face of common sense when we think that, well, I'll just get out if things get bad, because we know the market doesn't let you out.
And what kind of, you said everything needs to have a catalyst.
Yep.
And what kind of catalysts, what is the commonality between the catalysts?
The catalysts are really interesting because again, they often have very little, if anything, to do with finance. As an example, the catalyst for the panic of 1907, which is the first of the modern stock market crashes, was the San Francisco earthquake of 1906, which sucked up all of the liquidity, all of the free cash in Chicago, in New York, and in London, actually. And essentially all the free money, all the available money in those financial centers had to be shipped off to San Francisco to fuel the rebuilding. I mean, we have to remember that the financial center of the western half of the United States had essentially been destroyed. And any money that was actually in vaults in San Francisco wasn't available. Bankers were absolutely certain that the fires that followed the earthquake meant that if they opened the vaults, that all that money would burst into flame. So they weren't even able to use the money that they had on hand. That liquidity crush is really what started the panic of 1907 the next year. In 1987, it's interesting that we thought we were finally at war with Iran when we had the crash on October 19th. We had gone to war, essentially war. Our military had engaged the Iranian military the weekend before. And then we see that in 2010, rather, with a flash crash, the catalyst was rioting, arson, and murder in Athens. We thought all of the Eurozone was going to come unwound. The problem is the catalyst of the first crash was more than a year before the crash. The catalyst for the last crash was less than a day before the crash, and that time is collapsing. So investors have very little time now to see something, an event, think that might be the catalyst, and the crash.
And I also want to talk to you about volatility. You know a lot about volatility, and we've been talking a lot about it because the VIX is really low.
Right.
You prefer a different measure.
That's
Can you
right.
tell me about that?
Well, we have created we've created a different measure of implied volatility in the S&P world. It's Voldex, and the ticker symbol is VOLI. Anybody can go to their computer and punch up Voldex, VOLI, and they'll get the nation's Voldex. We measure volatility the way market participants generally measure volatility. That is, we look at at-the-money implied volatility. That is, how relatively expensive are at-the-money options on SPY. We much prefer that to the way the VIX is calculated. Now, regardless of how you measure it, Voldex is implied volatility is very low, much lower than it has been historically. There are lots of reasons for that. Some say it's complacency. I think it actually has more to do with the fact that the market just hasn't been very volatile. It hasn't bounced around. That's realized volatility, but it means that options just aren't particularly valuable. It might be something to worry about. If complacency means people are going to do stupid things, then we know that that doesn't end very well for the stock market.
Is it a good time to buy insurance?
You know, there's a saying, buy protection when you can, not when you have to. And it is certainly very cheap right now. But it's cheap right now for a reason. If I were at a point in my life in a demographic where I knew I was going to need my money out of the stock market in 5 years, or maybe even 10 years, and couldn't afford to take a big hit, then I think buying protection in the form of options would make a lot of sense.
And do you think that maybe volatility is just really low, not because people aren't fearful, but maybe because people just aren't in the market?
I think a lot of people are in the market. It could be that they've just put money in the market and they're not paying attention to it right now. They're not trading it as actively as they have in the past. That might be a case. That's generally a good thing. The fact that people invest and let their investments work for them as opposed to trying to trade around it. I also think that people have figured out that over time they can sell some volatility, they can sell some options to enhance returns in their portfolio, and that obviously depresses the price of options.
Great. And one question, after looking at all of this history, if you're in the midst of a financial crash, what should you do?
You know what, if it's already underway, then there's not too much you can do. The interesting thing is the crashes are all similar and they all unfold really quickly. If you were to panic once you're in the middle of a crash, you will likely end up selling the bottom. What is more important in that situation is what happens afterwards. What is the governmental response afterwards? People have asked, why did 1929 turn into the Great Depression when 2008 turned into a much milder circumstance? Now, it wasn't mild in 2008 if you lost your home or your job or much of your money, but the governmental reaction is often really what tells the difference. Federal Reserve was really on the case in 2009, and so if the Federal Reserve and the government are paying attention, then once we're in the middle of a crash and you have a little bit of money to put to work, you know, it's not a bad time to buy the bottom.
Thank you so much, and thank you to Scott Nations, author of A History of the United States in 5 Crashes. Earlier earlier, senior markets reporter Joe Scioli interviewed Wells Fargo Fund's chief equity strategist, John Manley. Here's what he had to say.
I'm Joe Scioli, and I'm here with John Manley, a chief equity strategist at Wells Fargo Funds, which manages about $230 billion. He's been in the market for about 40 years now, and he's really seen it all. But there's something I wanted to ask him about that maybe he hasn't seen, and that relates to the unprecedented monetary stimulus offered by the Fed. They're scaling that back. We're starting to see some rate hikes, and people are a little bit worried that economic growth isn't keeping up. What do you think about that? Are we in a dangerous situation with equity valuations near all-time highs?
When we worry about something, we very seldom get hurt by it. That's something you've got to remember. One of the things that happened back in 2007 is no one thought they had any risk. They thought they were all hedged, so they blew themselves up. If you're walking along and you know there's a cliff 4 feet from where you are, the odds of you going over the cliff are pretty low. So I think the Fed will be watching everything. They'll raise rates, but only to the degree they can do it without adversely affecting the economy.
Okay, and so could we see them maybe adjust the pace if the economic data isn't keeping up? I know that we've really been lagging the inflation target, and that's been a main criticism of people that think the Fed's maybe being a little too hawkish. Where do you come out on that?
I think they're fighting a one-front war. In other words, they don't have to worry that much about inflation. For all the talk of it for the last 4 or 5 years, it's been a no-show. So the Fed has to worry about strengthening the economy. So they can take their time. They can fix the balance sheet anytime they want to. They don't have to do it tomorrow. They have no oath registered having to do it at a certain time. They'll take their time, and I think Janet Yellen will watch everything like a hawk.
Okay. And so we've covered really one of the big stories in the market, but we can't really have a discussion about stocks without talking about tech. It's really been sort of the lightning rod sector of the last several months, if not since the election. I wanted to see what your thoughts were on that. We're seeing a lot of price swings, the NASDAQ moving 1 or 2% on a day when the S&P is barely changed. It seems like it's sort of a flashpoint for sentiment right now. Where do you come out on that? Do you believe in maybe some of the skepticism we're seeing, or is it a sector that you favor?
Yes, yes, yes. In other words, I think it's overvalued. But real growth stocks are almost always overvalued. The trick is when a growth stock that's truly a growth stock goes down solely because of valuation, when the fundamentals don't get tripped up, that's almost always a buying opportunity. No one else is really going to call those things exactly. But when they happen, as they have, usually it's like falling down an up escalator. You may be tumbling down, but the escalator is pulling you higher. The earnings are pulling you higher as the price gets lower. Well, take 10 or 15% off a stock price, raise earnings 10 or 15%, and suddenly you corrected a lot of the excesses we were worried about.
So you mentioned earnings growth. I mean, that's clearly been underpinning a lot of the positive sentiment. But at the same time, we have people chasing performance. They're looking at the FANG stocks that have been doing very well and kind of piling in. And people are starting to see that as maybe a crowded trade, maybe overcrowded. To you, I mean, outside of fundamentals, is overcrowding a problem?
I don't think so. It's not one I'm going to call. I mean, it's so hard to call an inflection point. It's so hard to call a top. I think the best way to do it is let the top happen. Let them fall. You may have to sell them 10 or 15% off the top, but that's better than selling them 50 or 60% off the top. Meanwhile, you just don't know how expensive they can get. I've seen 87. I lived through 99, 2000. Things get irrational. I was going to say unrational, but they get unrational, I suppose, is the stupid way of saying it. It is a stupid thing. But you have to adjust for that. A rational person has to adjust for an irrational universe at times.
Great. And so on the topic of crowded trades, there's also the low volatility trade. People betting that the market isn't going to go anywhere. That's been a very popular trade. We've seen a lot of people piling into sort of these VIX ETFs and shorting them, and that has also been kind of highlighted as maybe a potential disaster in the waiting for the market if that were to unwind, if we were to get some price swings. Are you afraid of the low volatility trade? Is that also an overcrowded trade that maybe inspires some uncertainty?
Well, you worry about it. I mean, anytime anyone goes short, it's like playing with fire. Short anything, you're playing with fire. You've committed to something you don't own, and it's a tricky situation. I mean, we've seen remarkably volatile politics and a remarkably unvolatile market. How can that be explained? The only explanation I can come up with is we expect the worst. There's an old saying, if you expect the worst, you'll never be disappointed. And no one's been disappointed yet. Now, they will be at some point in time. But I think that there's still that wall of worry. Why hasn't it gone down? When are we finally going to get it? This has been going on for 5 or 6 years. Maybe it's tomorrow, but I'd rather see it tomorrow and sell it a week after tomorrow than try and anticipate it, because anticipation's been the wrong thing to do.
I wanted to see, heading into earnings season, maybe what some of your thoughts were on some of the companies reporting this week. Obviously, you can't talk about Wells Fargo, but we have 4 banks reporting on Friday, including JP Morgan. Banks have been kind of highlighted as one of the potential areas of the market that are going to keep dragging us higher because of the earnings growth that's being forecast. What do you think? Are you optimistic about bank earnings starting on Friday?
I am. I can't talk about any stock individually, actually, but I think that there's a theme here, and that is that the fundamentals for financials are getting better. Rates have been unnaturally low. Now, that surprised people because low rates were supposedly good for banks. Well, they're not. You need a certain amount of interest rate to cover expenses. And I think as we go back to a more normal yield curve, if the Fed isn't really jamming on the brakes, but just raising rates in a slow, orderly fashion, that's a wonderful environment for the banks. I think you'll see their loss ratios get better. I think they can earn more money. You may lose some spread profits, but you don't put much of a multiple on that. You will get some profits, I think, from better loan growth. And those are the sort of things that make banks go up. So the valuation's there, the story's there. Finally, yet once again, I think I'm working in a good industry.
All right. Well, what about what Donald Trump's supposedly going to do with deregulating the banks? He's talked about repealing Dodd-Frank, and there's been a lot of chatter about a lot of equity gains being priced in already based on expectations of that. Let's say Trump doesn't get around to doing that anytime soon. Could that be something that takes the wind out of the sail a bit, or is it?
It could. I mean, for a while, but whenever I think of corrections, I ask myself, are they 2 to 3%, or 7 to 8%, or 20 to 30%? And I can't see a big one because of that. I think the fundamentals are getting better. Ultimately, the street looks to fundamentals. I've done this long enough to realize that while there are certain things that'll scare us from time to time, and certain things that'll really thrill us from time to time, at the end of the day, or the week, or the month, or whatever period you want to look at, if you give yourself a longer period of time, fundamentals matter. I think the fundamentals for the financials for the banks are getting better, and I'll play that.
Okay. And sort of the last thing I wanted to touch on is Amazon. It's sort of the specter looming over the market. We've coined the term getting Amazoned around here. It means when a company gets caught in the crosshairs and maybe Amazon buys one of their competitors and their stock price goes through the floor. We saw that happen with the Whole Foods deal. A lot of the grocers really got crushed. And a big conclusion that we reached was that that kind of put everyone on notice. Maybe there's no industry that's 100% safe from the tentacles of Amazon. What do you think about that? I mean, how are you playing the sort of this Amazon threat, that come in and rock an entire industry at a moment's notice?
Well, again, I can't talk about individual companies, certainly not Amazon, but I can talk about obsolescence. One of the good things about being old is you can look back and see how much things have changed. Things get obsolete. What's technology today wasn't necessarily technology 3 or 4 years ago. At one point in time, International Harvester was a technology company. Things change, and I think if Amazon is doing anything, they're merely the vessel of that change. They are trying to make things more effective. That's happening throughout the economy. That's a bad thing if you're in the crosshairs. But overall, how did we get to be where we are? How did we get to be the richest nation in the world? How do we live as good as we do, as well as we do? Well, I think it's because ultimately people did things more effectively and efficiently. And as they did them, they hurt other people who were doing them less efficiently. So I think you've got to be careful. One of the tricks about buying growth stocks is you have to realize the growth is still going to be there at some point in time, and it's going to go away at some point in time. So, I think Amazon may be an interesting touch point, but it's not the whole story. I think the story is watching for obsolescence, watching for growth, watching for the continuation of growth.
And just to kind of go off of that, I mean, you've said in the past that something that you think will help underpin continued gains in tech is just the fact that so many industries, whether it's energy, industrials, they're all adopting technology, and that in the end, if you go down the pipeline, it really plays back into the technology companies. Is that something that you think could, even if earnings growth were to dry up or slow, is that something that you think could keep tech going higher in the medium term?
I think so. I mean, I think if that's going on, I don't think earnings are going to shrivel up, unless they're spending more on R&D or something like that. But I think that's the story. They provide value. It's worth people to buy their products. And they're not being forced to buy their products. They're buying them because they want to. Well, that's how Standard Oil got started. That's how U.S. Steel got started. That's how Ford Motors got started. They could provide things better and cheaper than those who went before them. And I don't think the world has changed an awful lot from that.
Well, that's really all I had. I appreciate you coming in.
Appreciate it. Thanks.
That's it for this week. Henry Blodgett will be back next week. Thank you to Scott Nations and John Manley for joining us today. A big thank you to Fidelity Investments for making the show possible. And thank you to NASDAQ MarketSite for letting us hang out in your awesome space today.